The China narrative has done an about-face, and Alibaba is the latest victim. I'm Jack Otter, editor of Barrons.com. I'm here with Tiernan Ray, the technology editor at Barron's. So let's talk about Alibaba's latest numbers. You have a very insightful theory in terms of what's going on with Alibaba.
Thank you. I hope it's insightful. You use the word narrative, and that's exactly right. When Alibaba came public last fall, the story that was sold to investors was basically if you get 1% of China, it's so huge, it'll be a great business. And that was followed up with, shortly thereafter, with something called Singles Day, which is November 11th. 11/11, the idea being people would rush out and shop crazily because Alibaba had declared this sort of artificial holiday.
It was their Black Friday.
That's right, it was their Black Friday. And so the idea was, you just keep getting some take, however large or small, of this massive market. You can't go wrong. And this week, we're seeing the devaluation of China's currency, and we're seeing worries now that basically you don't want 1% of China, you don't want anything to do with China. So we've seen it flip.
And the numbers, while by most metrics fantastic, again, as we saw with Apple, didn't quite hit the whispers, weren't as great as people wanted, and so that's hurting them as well.
That's right. We had 28% top line growth. This is incredible. Over $3 billion in sales. To grow that large is amazing, but of course the numbers kept going up, and when you're saying you're going to get 1% of a huge market or 10%, it becomes very hard to hit people's targets, and it did slightly miss.
Now, you looked into the valuation. You said it's selling, around 26 times earnings,
right, which
for 28% growth, of course, sounds like a steal. Amazon is way above that in terms of valuation, to take one similar company. But among other things, there's a bit of a discount when we're looking at Chinese stocks.
That's right. We have, as you dig into the business, some things that you might call a black box. We have metrics such as what was the take rate of commerce on a mobile phone. And one of the things that came up today is people are shopping less in front of their PCs, in front of their web browser, and they're doing it more on the phone, which is good overall. But the problem is you've got a lot of competition for people's time on their cell phones. And there's a lot of investment that has to go on by Alibaba. And so you start to have this struggle over, well, how fast is commerce on a phone going to increase? How much of that is Alibaba going to take? And how much are they going to have to spend to produce that? And do we really believe this mobile take rate number? It's a percentage. What is it composed of? These kinds of things are abstract enough in the US when you're looking at Amazon.com or eBay. And there's maybe a little feeling that, like in China, I'm just a little bit less certain what exactly is in the sausage when you're looking at a number like mobile take rate in China.
Add to that, foreign goods just got more expensive on Alibaba because of the devalued yuan.
That's right.
And so this is a company people need to be careful about.
It's a company that you're going to see probably have this overhang, people think, of the narrative, to go back to your original point, flipping now, where everything becomes the macro question. And underlying that is this sort of deeper question of, well, how much do we believe these metrics? How do we know what's real and what's not in the evolution of the business itself, after we get done freaking out about China itself?
And that's why it is selling far below its IPO price, around the very lowest it's ever sold.
Yeah, 72 and change today. 71 and 3 cents is the lifetime low since its IPO last fall. So short span of time, but it's come way down. It was over $100 at some point.
Thanks very much, Tiernan.
Thank you.